Hello everyone, welcome to Prime Accounting Classroom. If you truly want to understand accounting beyond just numbers and calculations, then today's topic is very important. We're going to break down the key concept of amortization of intangible assets in a simple, clear, and practical way. By the end of this lesson, you'll understand what intangible assets are, what amortization means, why we amortize intangible assets, how amortization is calculated, and how it appears in the financial statements. Let's get started. 1. What are intangible assets? Before we talk about amortization, we must understand intangible assets. Intangible assets are long-term assets that do not have physical substance, but still provide economic benefits to a business. Unlike buildings, vehicles, or equipment, you cannot touch or see intangible assets, but they are extremely valuable. Examples include patents, copyrights, trademarks, licenses, franchise rights, software, goodwill. For example, a patent gives a company exclusive rights to produce a product. A trademark protects a brand name or logo. These rights generate income even though they are not physical. Under accounting standards like Financial Accounting Standards Board rules in the United States and International Accounting Standards Board standards internationally, intangible assets are recognized if they are identifiable and provide future economic benefits. 2. What is amortization? Now let's define amortization. Amortization is the systematic allocation of the cost of an intangible asset over its useful life. Notice something important here. For tangible assets like machinery, we use the term depreciation. For intangible assets, we use the term amortization. The idea is the same. We are spreading the cost of the asset over the period it benefits the business. Why? Because of the matching principle, a key accounting concept. Expenses should be recognized in the same period as the revenues they help generate. If a company buys a patent for $50,000 that will last 10 years, it would not be correct to expense the entire $50,000 immediately. Instead, we allocate it gradually over 10 years. 3. Why do we amortize intangible assets? There are 3 main reasons. 1. To match revenue with expense. If the asset helps generate income over several years, the cost should also be spread over those years. 2. To avoid overstating assets. If we never reduce the value of intangible assets, the balance sheet would show inflated figures. 3. To show accurate profit. Recognizing amortization expense reduces profit appropriately each year. Without amortization, profit would be overstated in some years and understated in others. 4. Useful life of intangible assets. Now here's something very important. Not all intangible assets are treated the same way. They are divided into 2 categories. Intangible assets with finite useful life. These have a limited lifespan. Examples: patent with legal protection of 20 years. A license valid for 5 years. A franchise agreement for 10 years. These assets must be amortized over their useful life. B. Intangible assets with indefinite useful life. These do not have a predictable end date. Example: goodwill. Some trademarks with no expiration. These are not amortized. Instead, they are tested annually for impairment. So remember this: finite life equals amortize. Indefinite life equals no amortization. Test for impairment. 5. How to calculate amortization. The most common method used is the straight line method. The formula is simple. Annual amortization expense equals cost of asset divided by useful life. Let's take an example. A company purchases a patent for $60,000. The patent has a useful life of 10 years. There is no residual value. Annual amortization equals $60,000 divided by 10 equals $6,000 per year. Every year, the company records $6,000 as amortization expense. Simple and clear. 6. Journal entry for amortization. Now let's record it. At the end of each year, debit, amortization expense, patent $6,000. Credit, accumulated amortization, patent $6,000. Notice something important. Instead of reducing the asset account directly, we usually create a contra-asset account called accumulated amortization, just like accumulated depreciation for fixed assets. On the balance sheet, it appears as patent cost less accumulated amortization equals carrying amount, book value. Each year, the carrying amount reduces. 7. How amortization appears in financial statements. Let's quickly connect everything to financial reporting. Income statement. Amortization expense appears as an operating expense. It reduces net profit. Balance sheet. The intangible asset appears at cost minus accumulated amortization. Cash flow statement. Amortization is added back under operating activities, indirect method, because it is a non-cash expense. Very important. Amortization reduces profit, but it does not reduce cash. 8. What about goodwill? Let's briefly talk about goodwill. Goodwill arises when a company purchases another company and pays more than the fair value of its net identifiable assets. Goodwill has an indefinite life. Under both FASB and IASB standards, goodwill is not amortized. Instead, it is tested annually for impairment. If its value drops, the company records an impairment loss. 9. Amortization versus depreciation. Quick comparison. Depreciation applies to tangible assets while amortization applies to intangible assets. For depreciation examples include buildings, equipment, while for amortization examples include patents, software. Depreciation may use multiple methods while amortization usually uses the straight-line method. Depreciation has residual value sometimes, while for amortization usually no residual value. The concept is similar, the terminology differs. 10. Common mistakes students make. Let me quickly mention common errors. Amortizing goodwill that is incorrect. Forgetting to calculate based on useful life. Confusing amortization with loan amortization. Expensing the entire cost immediately. Remember, amortization applies only to intangible assets with finite useful lives. Final summary. Let's recap the key points. Intangible assets have no physical form but provide future economic benefits. Amortization is the systematic allocation of their cost over useful life. It follows the matching principle. Finite life assets are amortized. Indefinite life assets are tested for impairment. It reduces profit but does not reduce cash. If you understand this concept clearly, many advanced accounting topics will become easier, including financial reporting and asset valuation. Thank you for watching. If this lesson gave you clarity in every concept, don't forget to like, subscribe, and turn on notifications. In the next lesson, we'll take practical real-life transactions and record amortization step by step using journal entries and T accounts so you can master it completely. See you in the next class.